And I want us to look at is what we call the inventory turnover ratio. Now, when we say inventory, I always tell you inventory is stock. So inventory turnover ratio, we're looking at the cost of sales all over the average inventory. Average inventory. Good. Now, what do we mean by average inventory? First of all, the cost of sales is usually seen as a line item in the income statement. So if you go to your income statement, you will see the cost of sales where we have revenue. You say less cost of sales, then you have gross profit. So you'll be able to pick your cost of sales as a line item. Now, when you come to average inventory, what do? As I told you, we are looking at 2 years usually for this analysis. So you look at the preceding period and you look at the current period. So if you pick up the inventory figure from the last period, that is your opening. So as of, let's say for 31st December 2024. Now in January, that is our opening. In January 2025, that is automatically our opening inventory. So you take the opening inventory, you say plus. At the end of the reporting period, you also have your inventory, which is the closing inventory. You say closing inventory. You add both of them, you divide by 2. You take the average. That will give us what we call the average inventory. So when you say cost of sales divided by average inventory, it will give you a figure, and that is what we call the inventory turnover ratio. What does this mean? It means that we've been able to keep our cost of sales down. We've been able to keep our cost of sales down by making very good control of our inventory. Remember that inventory, you have to manage your inventory so that you don't have too much of it and so that you don't have too little of it. So that you have what we call the stock management or inventory management. You have a very good inventory management system so that you don't waste funds, so that you don't have funds tied down. So there's no wastage. So if you do that, we'll say your cost of sales has been very, very well reduced because you made a very good management of inventory. That is what it means. And so it means the higher it is, the better for you. So if you are doing intercompany, looking at various companies, you have to take the one that is the highest. If you're also looking at periods intra-company, checking between periods, also the highest one is also the best for the period.